This is the Definitely Uncertain podcast, brought to you by Goldrock Capital. Each week, we look at how high net worth families can improve their lives, decisions, and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice. Welcome, everybody, to the Definitely Uncertain podcast. My name is Darren Rockman, and I am a partner at Goldrock Capital, the 20-year-old multifamily office servicing high net worth families in Israel and around the world. And today on the podcast, I am joined by my partner and sometimes host to this podcast, David Ram. Hi, David.
Hello, how are you?
Great. Good to see you. Well, we decided that this time we would take a slightly different tack and have a little bit of a chat about a topic which comes up very regularly amongst high net worth families, and that is hedge funds. And David is our in-house expert on the matter of hedge funds. So we're going to unpack the sector and our thoughts about that from the way we see it from the perspective here at Goldrock. So, Dave, let's start with what you see as unique about hedge fund as opposed to other ways of going long-only investing.
Sure. So I would kind of split it in between what a hedge fund is and how Goldrock, how we as a team perhaps try and utilize hedge funds within our portfolio. So a hedge fund basically is a investment structure which is less regulated than more of a mutual fund investment structure. So they're allowed to do a lot more different kinds of investing. They can take a lot more leverage. They could be much more concentrated. So they have a lot more freedom around the types of investing that they do. And they therefore are also much more focused and suitable only for high net worth investors and not regular retail investors, or limited, in fact, in the types of investments they can accept. And the second component, besides regulation, is fees. They're expensive. They have a high management fee, typically a 1% to a 2% range on an annual management fee of their assets. And on top of that, they even share in the profits of 15%, 20%, sometimes even more than 20% of the profits. And rarely is there any kind of a hurdle rate. Rarely is there some kind of a performance minimum that is required to reach before they share in those profits. So if a fund, just in general, if a fund is able to generate 12% return in a year, they're going to take about 2% or so management fee. That goes down to 10, and then another 2%, another 20%, of the profits. So 20 times 10% is another 2%. So it goes from 12% down to 8%, which is the net return to the investor. So they take 4% of the 12%. That's a pretty sizable chunk of the overall performance. So that's kind of what a hedge fund, I would say, is. Less regulated and a higher fee structure. The way we try and identify hedge funds is to say, okay, I'm not only interested in making sure they make lots of money and do whatever they want. We want to make sure that they're doing things which is hard to do for us to do on our own, and their fees that they're charging are justifiable. They're getting paid for a job that we cannot do and we cannot duplicate. That's kind of how we our efforts.
So before we sort of go into that, let's just give this some context. 4% on a 12% return, that's a third of the fees. If we then compare that, say, to a regular ETF on the S&P 500, you're going to be paying there somewhere between 20 and 40 basis points. So a quarter, 0.5% per annum. So really the difference between a hedge fund structure and what would be probably the cheapest way of going into markets today can be 3.5%, 4% per annum. That's what the investors are going to be paying in a good case to the manager. And what that does really is it just really increases the hurdle that a manager has to get over in order to justify his existence.
That's exactly right. I would even say that, if you just buy the SPY or the SPY, it's 7 basis points. I mean, there's plenty of ETFs that are extremely cheap, and that's probably the most popular one out there is the SPY. And that's correct. I think that obviously it incentivizes hedge funds to take significant risk in order to get over that significant hurdle that you just mentioned. And on top of that, in down market environments, if they have some level of correlation to the financial markets, they're already starting at a negative 4% or negative 2% in a non-profit share year. So they are way behind the eight ball, so to speak.
Just getting out the gate. Yeah.
Just getting out the gate. And therefore they have to have this game where they are taking outsized risk to justify the fee, and at the same time mitigate downside when the markets don't work out the way they want them to. So the truth is that kind of is the reason why it's really hard to be a hedge fund manager, honestly. It's not as easy as it sounds. It's not as easy to perform well in up markets and protect on the down.
Okay. And, I think on the sort of fees question, the best illustration of that was obviously the Buffett Bet, which happened in 2008. Warren Buffett famously made the bet saying 10 years of performance. I think that the stock market will be better than a given hedge fund, and of course he was proven to be right. And his argument was simply this question of how are you going to be able to beat the fees? And I think that we've probably seen a similar thing within the portfolio and funds that we track here at the firm, where you get outperformance years, but there are plenty of underperformance years and sometimes really disastrous years, which offset those.
That's absolutely true. It's absolutely right. And I mean, I would just add the funny thing. I think Buffett has in his will that after he dies, 90% of the money goes into the S&P 500. So obviously, he has a lot of faith in that instrument as a long-term value creator. In terms of their abilities, absolutely. So I mean, I think the focus that we spend our time on to make sure that we're getting our money's worth in hedge funds is trying to avoid funds that are correlated to the financial markets. And frankly, that's got to be, I would say, well over 50%, probably closer to 70 or 80% of the overall market. There's 10,000 hedge funds in the market today. The vast majority of the hedge funds in the hedge fund market have some level of significant correlation by design. And that kind of reduces our market that we're looking out there for hedge fund opportunities. So we try and focus on areas that are, in fact, by definition, by design, uncorrelated. So a typical long-short equity fund, which is over half the market, would be rare in a Goldrock portfolio. It could happen, but it's rare. So,
long-short equity fund, basically long a book of equities usually, and then short either an index or some specific names. Those strategies were really built, we're going back to the sort of 80s here. Those strategies were built in order to do two things. One, to reduce or dampen the volatility. So when markets fell out of bed, they didn't get hurt as badly. And secondly, because these managers, many of them thought that they would be good at picking problematic companies as they were picking companies with a good outlook. And I think that over the last 15 or 20 years, that strategy has become harder and harder, and probably more than anything, simply because there are so many hedge funds chasing those opportunities. Yeah, I think that those two groups are exactly right. What you said, which is one is the dampened volatility, and the second category is what they call in the market the alpha shorts, meaning that they're doing single name shorts positions where they want to make money both on their longs and on their shorts. And we just saw that recently with that famous case with Melvin Capital, which was shorting stocks like GameStop, AMC, and others, and they lost something in the neighborhood of $9 billion in a very short period of time. And the reason why, for a week's work. Exactly. The truth is he made $3 billion in partner capital as a result as well, but that's a different story. But yeah, absolutely. I mean, that was a crazy, crazy story. But at the end of the day, when you dampen volatility, like you suggested, Darren, which is, okay, in the most simple approach, let's say a manager has 10 stocks that they really like, and they want to make sure that they're only getting the value of the 10 stocks above and beyond a typical market performance. So they could take 10 stocks, put $10 in each stock, so they have $100, and they could then short the S&P 500 and short the whole market as well, and they can just isolate, so to speak, the value creation above the market. That is old school hedge funds, like you mentioned, from the 80s.
which is very hard to get working today because the ability to create value above and beyond the market when a market is generating such high returns is very, very challenging.
Right. But of course, I think we should caveat that because 2020 was one of those years where that strategy actually really, really worked. And mainly because there was such disparate, when all the markets move in the same direction, more or less in the same way, it's very hard to make money in the strategy you described. But 2020 wasn't like that. You had this exogenous shock, COVID comes in, hotels get battered, online e-commerce does incredibly well. In a market situation like that, hedge funds, long-short hedge funds actually can do quite nicely.
Yeah, because as you pointed out, when you have sector dispersions, which happens every year, but I think in 2020 it happened more starkly in a few different sectors. And what the hedge fund guys have been doing, I would just take a step back and say as follows: by nature, most hedge fund long-short equity managers, and these are the guys who Goldrock typically does not invest in, by the way, but those typical long-short equity managers in hedge funds are fundamental-oriented investors. And what they've learned over the past many years, 5 to 10 years, is that's a crappy, unfortunately, strategy when the Fed has interest rates at zero and growth is being rewarded out in an outsized way. And then what ended up happening over the past about 5 years or so, the successful guys poured a lot of their funds into growth stocks. So when you walk into COVID, a lot of the large long-short guys had massive positions in pretty crowded trades like Facebook and Google and Netflix and others. And those are what they call the stay-at-home stocks, the stocks that worked well when people were locked in their houses during the pandemic. And they were not so exposed to things like energy, airlines, retail, et cetera, because that's more of a value-oriented play. And that really helped them. So I'm not, a lot of them are super smart guys, but a lot of them did really well by accident almost. Right.
Being in the right place at the right time, which, by the way, is always a great strategy. If you can always be at the right place at the right time, hey, give us a call.
Absolutely.
So, if you sort of say, okay, we're going to exclude that maybe 70% of the market that's in the long-short world, because you say, that I can get exposure to that through very, very cheap, very, very liquid ETF or maybe even mutual fund managers. What happens when you start to look at less efficient markets? Markets like Israel, markets like emerging, China, places like that. Is there a role for long short in that market, in your view?
Yeah, it's a great question. So I think in general, whenever you reduce the amount of efficiency that the hedge fund is trying to expose themselves to, that's where it can get interesting. And with a good track record and proof that they can actually execute well, that's where hedge fund strategies and the fees that they charge start getting more worthwhile. So yeah, in markets, in regions that are less efficient, Israel is a great example. South Korea is a good example where it's a market that respects the rule of law, but yet it's unusual in a less accessed market, or markets like small caps or micro caps as well in some aspects. What I would also add is that there's other ways you can reduce efficiency. Concentration is an easy way. The S&P 500 is exactly that. It's 500 companies. The Tel Aviv 125 is 125 companies. So if somebody has 10 stocks in their portfolio and that's it, by definition, they're going to have more idiosyncratic risk, more idiosyncratic upside, and therefore they're going to have an ability to outperform and frankly underperform as well in a much more meaningful way.
Because they have more idiosyncratic downside.
Right. They will move up faster and down faster because they're more concentrated. Leverage is another example of how funds can increase the ability to get out of the efficiency world. So any place that they're avoiding what they call the crowded trades, which are very concentrated hedge fund positions, or they concentrate their book more, or they add leverage more. These are the or they focus on regions like you mentioned, Israel or other regions like that. That's where it gets a little bit interesting. And for us, that's what we try and identify. We try and measure historical performance of hedge funds to figure out, okay, let's analyze alpha, meaning outperformance above the market that we can easily access and invest in ourselves. So if somebody's investing in Israel, I can easily access the Israeli market in a number of ways. How much alpha, how much value add above and beyond the market exposure that I could get myself is that manager generating for his investors?
Okay. So now let's move away to the long short, to that other, call it 30% of the market.
Sure.
And there, I think, our strategy here at Goldrock has been to try and find those areas where we're getting really two things. One is we're getting a non-correlated return. So moved away from financial markets, moving away from, the way the equities move or the bonds move. And the second thing is a lower volatile return. So something that's maybe not predictable, but less likely to have sort of extreme outcomes. The return outcomes are tighter around a certain average. How difficult is it to find those types of strategies out in the market today when there is so much money chasing return?
Yeah, very is the short answer. And there's a short list of strategies. Well, one of the reasons why it's difficult is because I'm going to focus on the lower volatility, like you mentioned, where you have a tighter return profile and an understandable return profile. The reason why that's been quite difficult is, first of all, with the zero interest rate environment, those low volatility strategies also generate quite low returns. So to pay, as we spoke about earlier, about a 2 and 20 or 1.5 and 20 strategy where you generate 12% gross and it goes down to 8% net in a very low return environment, in a low volatility environment, it's even worse. You can generate 5% gross, and then the manager is taking 3 of it. So you're left with 2. And so they'll say, oh, well, you're getting 2. You put the money in the bank, or you buy a fixed income product. You have more correlation, or you have zero return. So at least you're getting something for your money, but you end up taking a 5% risk and generating 2%, 2.5%, whatever that may be.
Or maybe even a greater risk, because you have the lack of transparency. You don't know what the manager is going to do. You have managers that have bad days and do stupid stuff.
Yeah, and obviously with less regulation in the hedge fund space, they have the ability to do a number of things which can increase risk dramatically, like you're suggesting, Darren. So that's something you have to keep your eye out for. But we try and identify strategies that either are outside of the typical equity fixed income world. One example, I'll throw out one example, is like insurance-linked securities as an example, which obviously has nothing to do with the stock market. Another example could be things like commodity futures, things like that, where you can have a strategy which is trying to do something either in the arbitrage world or in the positive carry strategy, where they're trying to collect some kind of a premium. Something along those lines, where they're not really related to whether or not the stock market or the bond market goes up a lot or down a lot. And those kinds of strategies oftentimes have an understandable return stream, but it is difficult to find ones that generate a reasonable amount of return for the risk you're taking. As you suggested, even the manager itself is a risk, right? So you want to get paid for the risk you're taking and not take directional financial risk. That's not easy to do today in zero interest rate environment.
Okay, so summing up to where we've got to now, the Goldrock view, at least as it stands today, and these things do change, but we're in early 2021. Is if you want directional risk, you're better off with a very cheap solution. If you are in a less efficient market, then yes, there's room for a long short manager that can take advantage of those inefficiencies. And where hedge funds fit into a portfolio, very much is in the sort of non-correlated side, where you're able to generate a return even in down markets, and you're not necessarily going to pick up as much as you would in up markets. So in a year like 2020, when stock markets really bolted ahead, that's going to generate a return, but under what you're going to see in other parts of your portfolio. But in months like February, March, where markets completely fall out of bed, you're going to have the security that these strategies are going to do okay. So, with that in mind, how do you see the role of a hedge fund in a high net worth portfolio? Where does it fit in? What is it doing that other assets, real estate, private equity, bonds, equities, cash are not doing?
Yeah, so that's a good question, because there are, as I mentioned earlier, about 10,000 hedge funds out there, and every hedge fund is doing their own thing and associated with their own underlying markets. So what we try and do for a client within a portfolio is to try and provide value to that portfolio. So a typical portfolio will have directional exposure to the financial markets, including equity and bonds. They'll often have directional exposure as well in less liquid environments like private equity or venture capital or things of that nature. And what we're trying to do is we're trying to provide a return stream of both low vol, as you suggested, or even higher risk type strategies, where the return stream that the funds generate are not related to other parts of a client's portfolio. That's what we're really trying to do. Now, it's not easy to get that 100% right. And we're definitely, I would even say that we're definitely not trying to provide a ballast, meaning an opposite reaction to the markets, because that means you're basically losing money most of the time. So we prefer to generate something that creates a return stream, but is not dependent on a correlation to the market. But you'll have some correlation, hopefully as low as possible, but you'll have some correlation. And that's kind of what we're trying to do. So things that have zero beta or zero correlation, things that have return streams that are maybe income related, that are not related to bonds, or things that have the underlying is different than just a company or a piece of real estate.
Right, and as you said, that those aren't easy to find. Where do you find them? What are the things that you do when you're out there? With your
sauce.
The secret sauce, hunting with your rifle in the hedge fund jungle in Midtown New York or in Mayfair.
So I would say one quick thing about the hedge fund market from an investor perspective is that there are some investors that have somewhat of a responsibility to fill a bucket of managers, based on their job, which is, if they're an institutional investor, they have to fill, the quasi-liquid hedge fund bucket up to a certain number of managers, and they go off and do it. We don't have a responsibility to fill any buckets. We can, we are driven by our clients' portfolios. We're driven by our clients' interests, and we try and provide value to those clients. So I have no responsibility to do so. But what I do, in fact, try and do on the deal flow side is be as proactive and as thoughtful as possible. So going out to events, talking to other like-minded investors, primarily in the US and the UK, and trying to identify areas of interest, managers of interest. It does take quite a bit of work, unfortunately, but in terms of the results, I think the results are trying to create a portfolio of funds that do exactly what we've been talking about. So it is not easy. As I mentioned, there are 10,000 funds. I also mentioned it's not easy to be a hedge fund manager. That's why they get paid the big bucks. So a lot of hedge funds come and go. And a lot of hedge funds do really well in the beginning, and then as they grow, do a lot worse. So you have to kind of know the people you're backing, know the strategy that they're trying to create, and really understand incentives. That's a very important part, which we haven't really spoken about a lot, which is incentives drive what the fund will do. Okay, Economics 101. You got to track why they get paid, how they get paid, etc.
Who gets paid?
And we said no to a lot of funds that we don't particularly appreciate their fee structure, their liquidity terms, how they make money in the fund versus their fees. There has to be an incentive that's aligned with investors, and we've missed out on great funds, honestly, which have done really, really well. And we just don't want to be a part of a fund where the alignment of interests are not there, and that's very important to us as well.
Yeah, so I want to pick up on 2 points you said and maybe just expand on them a little bit. The first one around this incentive point, very often we will see funds where the underlying holding of the fund is very, very liquid, regular sort of stocks. Yeah. But the investor in the fund has to commit to leave his money in there for multiple years. And we very often reject funds like that on the basis that, there's no reason why. The only advantage here is to the manager, and you're effectively giving the manager an incentive to really play with your money and collect up assets as long as possible. Very often they're doing so in order then to sell off their business or parts of their business to third parties. So that's sort of one aspect of it. And the other one is the carry structure, which is, very often, people, these funds are taking carry on an annual basis. And, if they're holding assets that have a long-term hold, that's not necessarily in the investor's interest.
Sure. I would even say, just quickly on that last point you made, Darren, that I've seen many funds, and I would be honest to say that a number of years ago, we had a fund like this, which is unfortunate, that took carry quarterly. So when you have a fund that takes carried interest profit share on a quarterly basis, and they're very volatile, they move up and down very quickly. They can be up 10%, down 10%, up 15%, down 15%, et cetera. What ends up happening is that they're actually taking the profit share very, very often, every 3 months, which means they could literally make millions of dollars and then go down a lot. And then, okay, there's a high water mark. They have to get back up to that point where they took profits. But, who knows if they'll ever get back there again? So, it's one of those situations where either they win or you lose. Exactly. Exactly.
Right.
So frequency of carry is important. And I want to get to the point where you made around taking profit share every year, and they have a lot of illiquid underlying holdings, which is a major trend, I would say, which is, I have to be honest, I'm going to say I'm shocked. I'm actually upsettingly shocked that it's happening again. This is something that was very prevalent in the hedge fund market prior to 2008, which was that hedge funds would invest in illiquid assets and then just assume nobody would ever redeem. Why would they, right? They're fantastic. And that was an unfair treatment. And there was a thing called gates, where they kept investors in the fund even when they wanted to leave, or side pockets, where they put some of the capital, the investors' money, to the side in those illiquid assets, and they didn't know they had to do that. And then after 2008, and so many hedge funds went away because they were creamed or they were frauds or whatever would happen in those days. And then the hedge fund market started growing back up again. We're now back at a point when they are doing this strategy where they're investing a lot of their assets in illiquids. And the reason why, they have all the great
private equity, venture capital, companies that are not traded and not easily liquidated.
Exactly. So think about if you're a technology-centric long-short equity fund in the hedge fund world. You typically are buying things like Google and Facebook and Amazon and whatever. Maybe smaller companies, the newer ones like Israeli ones like Wix and Fiverr and all that fun stuff. Now, all of a sudden, they realize, wait a second, these companies stay private for such a long time, or perhaps they have information that the companies will, in fact, go public. So they want to get in earlier, and the only way they can do that is with permission from their investors, that they can go down private and invest private companies that they can't trade in and out of. So when an investor invests and then decides for whatever reason to redeem his money, to get his money back out of the fund, they cannot get the money out of those private deals. So the fund has a few options. They could either sell down more liquid assets and give the investor all of his money back, or they can focus. They can side pocket part of that money into that deal. So these are challenges, and I often speak to other investors in the hedge fund space like us, and they love these funds, and I find it to be so surprising, honestly, because I always say, I'd rather have a venture capital investment, and I'd rather have a hedge fund investment. And my venture capital guys will get paid profit share once they actually realize, once they actually get the exits.
Yeah.
Give me my cash back. Once I get my cash back, then they take profit share. But hedge funds don't do that. Hedge funds never do that, actually. Hedge funds only take profits whenever they take profits. And that is usually once a year, sometimes once a quarter even. So every year, at the end of the year, they look at their numbers and say, I'm taking this profit now, even though they didn't sell the stocks, you didn't redeem anything. So and to do that in venture capital is very aggressive. And what can end up happening is you could be in one of those funds where they take a lot of profit share, and then you have to redeem, and they may be way down, and that's it. You paid out a lot of profits without realizing any benefits.
Yep.
So we would discourage anyone from investing in those kinds of funds, even though they look really attractive on paper.
Yep. And that probably leads into a discussion about private equity and venture capital, but that's not the topic for today. And we're gonna wrap up here. Dave, thanks very much. That was very informative, a lot of fun. And we're, of course, happy if anybody's got any questions. You can send us an email to podcast@goldrockcapital.com. And if you happen to have any suggestions for future episodes or topics that you'd like us to cover, again, please be in contact. We love to get feedback from our listeners, from our growing group of listeners. And you can also give us a 5-star rating on Apple Podcasts if you think that other people might enjoy this. It's a great way to get the word out. So, Dave, thanks very much.
Great. Thank you.
And everybody, we'll see you next time.